Okay, welcome back everybody. We're going to do a completely different session now. So we're going to be expecting lots of participation from you. In particular, you're going to be doing lots of voting, so please enjoy the session. It is supposed to be fun. I always get depressed when people say accounting is not fun, because all accounting does is it is supposed to reflect underlying economics. So if underlying economics is boring, then accounting is boring. If underlying economics is interesting, then accounting must be interesting. Okay, so accounting is interesting. If it's not interesting to you, somebody's telling you something wrong, I think. Okay, so accounting should be interesting. So I'm Mike Wells. I lead the education initiative at the IASB and the IFRS Foundation. I must start by saying anything I say is my own opinion and not necessarily the opinion of the board or the foundation or anybody else, and it'll probably become apparent to you why I say that before I say anything else today. Okay, so we're going to start with an overview of measurements. So, what measurements do we have in IFRS? And perhaps we'll do some examples to see if we can measure some of the items that people think they can measure. Before you can do anything in IFRS, absolutely anything, you have to be looking through the right lens. And by that I mean you have to be focused on the objective of financial reporting. The objective of financial reporting is what every requirement in IFRS is aimed at achieving. So when you're trying to make an IFRS judgment, this is the context for the IFRS judgment. This is what the IASB is thinking when they write the requirement. So this is the lens that you are looking through when you make any judgment in IFRS. So it's about providing information to investors, lenders, and other creditors, both existing ones and potential ones, for the purposes of them making decisions about providing resources to an entity. Buy, hold, sell, shares or debt, okay? Make a loan to an entity, take a loan back from an entity. That is our sole objective. That's what we are trying to achieve with IFRS. All the requirements are aimed at achieving that objective. So that is the lens you look through when you are looking at any IFRS judgment. Okay, and it's even narrower than that, and many people don't see this, but paragraph OB5 of our conceptual framework says we are focusing primarily on the people who are not in a position to demand the information from the entity. So not the controlling shareholder. The controlling shareholder can demand any information they want. Okay. It's people who cannot demand information from the entity and therefore have to rely on the financial statements. Okay, so we think the information is there to help them make their own assessments of what the future cash flows of this entity might be. How uncertain are the cash flows? What are the prospects for the cash flows? That kind of information. And to make those kinds of estimates, they need information about the resources, the assets of the entity. They need information about the claims against the entity, the liabilities and equity claims. And they need stewardship information. They need information about how well management is looking after those assets and the purpose to which management is putting those assets and how they are protecting those assets. So that's the color, if you like, which is being built around the objective. And for information to meet that objective, it must be relevant. Okay, you would think you wouldn't need to say that. Okay, so irrelevant information is a waste of time. We shouldn't be wasting space writing down irrelevant information. We're interested only in relevant information that can be faithfully represented. If those two things are there, it is relevant and it can be faithfully represented, it is then even better if it is comparable, so we can compare entity to entity. It's verifiable. We'll look at what these things mean. It is timely and it is understandable. But it is useless being those second group of things if it is not relevant and it cannot be faithfully represented. Okay, and this is important because it comes down to how we set the requirements that you have to apply or regulate. Okay, so what does relevant mean? Remember, we said this is all about helping people make their own projections of future cash flows. Okay, so it's relevant if it helps them predict future cash flows, essentially. And we are only interested in material information. If something is not material, if it could not affect a user's decision, we don't care what you do with it in IFRS. You can expense it immediately if it's an asset. You don't have to disclose it. If it's immaterial, you do not have to do anything with it. So what is a faithful representation? It is complete. It is neutral. Not conservative, neutral. Okay, we are aiming to provide neutral information. And ideally, it must be free from error. Okay, now many people misunderstand comparability. Okay, so the ones we had on the previous slide, these are the ones you have to have. These are the nice to haves on the next slide. Okay, so this makes information better, but it's not essential. So comparability, things are comparable when like things look alike. Don't confuse that with uniformity. We could say everybody has to depreciate all motor vehicles on the straight line basis to a nil residual value over 3 years. That would not result in comparable information. That would be uniform information. We would be making unlike things look alike. The way different people consume the service potential of a motor vehicle differs. Some people might keep it 10 years, some people might keep it 2 years. We don't want uniformity, we want comparability, and that means we have to make judgments so that we can get relevant information. And look at verifiability. Okay, this is where auditors get a little bit excited when we're speaking about verifiability. Okay. It can be indirect. It can be that you can check, you can verify the inputs to a model. Okay, there was a case where the UK regulator just a month or two ago told a company to restate their financial statements because they could not measure, or they had measured inappropriately in the regulator's view, the fair value of some level 3 assets. So the company restated, the auditor signed again, the regulator looked at it again and said, this is still wrong, go restate your financial statements again. That's a level 3 input. It is still verifiable. And that's important. We're not about precise numbers. We're not trying to say the number is exactly 100, okay, for a level 3 measurement. But the number's certainly not 0, and it's certainly not 1,000,000. Okay, it's somewhere near 100, if you understand what I'm saying. Okay, so it's not about precision. It's about a faithful representation providing relevant decision useful information that is verifiable. Okay, so I think that's important. Okay, and I think the others stand on their own. Just the IASB also has a cost-benefit constraint, so we can't set requirements. We're complying with the requirements. The costs of doing that would be bigger than the benefits that people have from using that information. And that's sometimes why we don't set the theoretically best requirement, because if the costs exceed the benefits, we can't do that. Okay, so we nearly finished with the theory. We're going to get to some exciting things in a minute. Our conceptual framework is rubbish when it comes to measurement. Okay, it just lists, we observe in the world there are a few different ways people measure things. We're trying to fix that now, so there was a discussion paper, and the discussion paper had some ideas about how we could consider which measurements to require in which situations. Okay, we're now building on issuing an exposure draft. You must comment. You must help the IASB to set measurements that are relevant. So you need to comment. When those discussion papers and exposure drafts come out, you need to help the IASB to set the best possible requirements that they can set. So we ask you to do that. Okay, so how many measures do we currently have in IFRS? Okay, these are just some that are listed on this slide. Okay, someone once did an analysis, and I can't remember if it was 26 or 36, but I think they didn't get nearly to all the different combinations of things that can happen. Okay? And most people look at that, including the IASB, and say that's too many. Okay, we should have less measurement bases. The IASB said, though, we're not saying there should be one. So there's a misconception in the world that the IASB wants fair value for everything. Okay, that's not true. Okay, personally, I might like the idea, but that's another story. Okay, so the IASB says there should be more than one measurement, but we shouldn't have all these measurements that we've got now. So some things are measured at what most people call historical cost, the original cost, and we're going to have a look to see if we know what that is in a minute. Then there's modified historical cost, where we take historical cost and we start adjusting it for things. Then there's fair value for some things. Then there's modified fair value, so it's not quite fair value, it's a bit like fair value, but not quite fair value. Okay, and then we have entity-specific measures like value in use when we're impairment testing some assets. Okay, net realizable value in inventory. And then we have some super mixed measurements. Okay, things like the equity method, things like we have hedge accounting, so you have some asset that's measured in some way, and then you adjust it for some other things, or first-time adoption, or transitional provisions. Okay, the list goes on. Okay, so sometimes we have very mixed measures. So measurement is complex and measurement is important. People fight over measurement more than anything else. Okay, so measurement is important. Okay, so one of the measures that's identified in our conceptual framework, and it is in paragraph 55, 4.55a, it defines unmodified historical cost, and it says it's the amount of cash or cash equivalents paid, or the fair value of the consideration given to acquire the asset at the time of its acquisition. And some standards, because this is from the conceptual framework, some standards will take that a little bit further, like IAS 16 will say, or it's any other number that any other standard tells you that it should be for the purposes of applying this standard, like IFRS 2 might tell you to use a different number. Okay, but we're going to make it simple for the purpose of the exercises we're going to do. We're going to stick just with what we have in our conceptual framework. Okay, and I'm going to be asking you, can you tell me what the cost of this asset is? And don't be embarrassed if you get it wrong, okay, because we'll be using voting buttons. But I would be very surprised if you all come up with the same answer, because historical cost is a convention, it is not a concept. And if it's a convention, your convention can be different from my convention. And we see the questions that come to our interpretations committee about what is the historical cost of this asset. Okay, and some jurisdiction will say, no, the historical cost is this, that's our convention. And another jurisdiction will say, no, the historical cost is this other number, that's our convention. Well, we don't have a concept, so who's right? Well, we must just choose a convention. Okay, so you'll see it'll become apparent to you as we do the examples. So it's important that you keep this slide marked, because this is what you are answering when we ask you what is the historical cost of a particular asset. Okay, so let's go with the first example. Okay, so today you get control of a new aircraft, and today when you get control of that new aircraft, okay, and there are three components to this. We're starting, but the first component's easy. You pay 100 cash. Okay, so we're starting with something easy. You're not voting yet, but if you were voting, you would say, yes, it's the 100 cash I paid today, and no one would disagree with you, okay, because clearly it would be the 100 cash that you paid today. But you didn't just pay 100 cash. You also gave the person from who you're buying this asset in exchange for this asset some landing rights that you had. The historical cost, the original cost, was 50, but you've depreciated them because you've been using them. You've used them up, if you like, to a certain extent. So the carrying amount in your books, okay, is depreciated historic cost of 40, and their fair value is 60. Okay, so now think back to the definition. It's what you paid or the fair value of what you gave up. Okay, so you all had the 100 cash. Okay, now you've paid or given something up as well. So when you're looking at the what you're giving up, the landing rights, is it the 50, the 40, or the 60 that's going to be part of the cost of the aeroplane that you're receiving? Okay, and that one, the convention in the world is pretty much the same, because the standard tells you what the answer is when you come to, say, IAS 16, that would apply to this one. So everybody's convention in the world is the same. But also, to buy this aircraft, you had to get into the queue to buy the aircraft. And to get into the queue to buy the aircraft, you had to buy a ticket, I'll call it. And the cost of the ticket when you bought it was 1. But by the time you got to the front of the queue, okay, when you can hand your ticket in and get delivery of an aeroplane, okay, by paying 100 and handing over the landing rights, okay, by the time you got to the front of the queue, economic times were good, and the fair value of the ticket was 10. It's a transferable ticket, so you could give it to somebody else to use. So now you have to decide, is it 0 of the ticket that I count in the cost of the aeroplane? Or is it 1 because I paid 1 for the ticket? Or is it 10 because that's the fair value of the ticket I gave up to get the aeroplane? And you'll be forgiven for disagreeing. Because I don't think there's a right answer to this question. Okay. So we started with something easy. You all agreed 100. Now you're going to have to add something from the second line. You're going to have to make a choice on the second line. And you're going to have to add something from the third line to come to a number that you're going to key in as the cost of this asset. And this is just a simple item of property, plant, and equipment. It's the aeroplane I flew on to get here. So this is simple. We're not dealing with complex financial instruments. This is a simple asset you've gone to buy. Okay. Do you all want to make your choices? Okay, shall we start voting now, please? Okay, have you all made a choice? Okay, so let's see what the choices are. Okay, so cost is easy. Okay, we don't even have a majority for one of those numbers. Okay, and this is just the cost of an aeroplane. Okay, we're going to get to other measures too, so don't worry. Okay, so going to the next one. Our next example, again, we're just looking at measuring the simple historical cost of something. So we're buying a machine now, and the first 2 bullet points we're not going to vote on. We're just going to vote on the third one. So if you go into the shop today and you pay 121 today when you take the machine, you get control of the machine, you would all agree, I'm sure, the cost is 121. Now let's say you get the machine today, but you're only going to pay for the machine in 2 years' time. Okay, the convention is set out in the standards. It tells you you must discount to the present value, doesn't it? So all our conventions are the same around the world because the convention's been codified in the standard. Okay. But what happens if I pay 100 today and I'm only going to take delivery of the machine in 2 years' time? That convention's not codified in the standard. Okay, so economically, because this is all supposed to reflect economics, if you were buying a if you were paying for a machine today that you were getting delivery of in 2 years' time, would you pay less today because you're giving up your money 2 years in advance? Would you adjust for the time value of money? Would you expect to pay less? Just like if you were paying 2 years later, you paid more, didn't you? Because you had to pay interest. Okay, so that's how one jurisdiction might look at it. But other jurisdictions might just say you paid 100. So the cost of the thing is 100. Another jurisdiction might look at it and say, surely it should be the fair value of the machine on the time that you took delivery of the machine. So why would you only adjust for the time value of money price changes and not adjust for all other price changes? So another convention could be to say the cost of the machine is 170. What do you think? Okay, so you're looking just at the last one. Okay, so you're ignoring the first two bullet points. You're looking at you pay 100 cash today to take delivery of the machine in 2 years' time. And in 2 years' time, when you take delivery of the machine, on that day, its fair value was 170. What is the cost of this machine? Do you want to vote now? Okay, it's slightly easier than the first one. We started with a, shock treatment. Okay, have you all keyed something in? Let's see if we can see the answers. Okay, so again, we don't have a majority. We don't know what the cost of this asset is. But cost is simple, isn't it? It's fair value that's difficult, isn't it? Isn't that what people say all the time? Okay, now this is a personal example to me because my family are sheep farmers. Okay, so we're not going to make you vote on this because I couldn't possibly think of all the possible answers we might have for this one. But when I walk out onto the farm in the morning and I see the 100th generation sheep, what is the cost of that sheep if my grandfather paid, or my great-grandfather, for the original flock, 1 currency unit per sheep? So remember, the thing about sheep is you walk out onto the farm one day, you've got 1,000. You walk out the next day because it's lambing season and you've got 1,800. And 100 generations later of sheep, you've got quite a lot more sheep. And So what is the cost of a sheep? Can you imagine writing something to say what the cost of a sheep is? Yeah, I can imagine it. I could write it. But what I write will probably be different from what you write and you write and you write. So we could write a convention for what the cost of a sheep is. Okay, but, it would be quite a complicated thing to do. And to get agreement, for me to persuade you that my convention is right and your convention is wrong, we're going to have a lot of fights about that. Okay, as a farmer, when I walk out into the farm in the morning and I see all the sheep there, I'm not thinking, what was the cost of that sheep? Okay, I hope an investor that's thinking of buying my farming operation is not thinking, what was the cost of that sheep? Because I remember when I studied accounting at university, we also did another course called Managerial Accounting and Finance. And in that course, they taught us about sunk costs. Did any of you study sunk costs? And what did they tell you about sunk costs? They're irrelevant for decision making. And then you did another course, financial reporting, didn't you? And what did they teach you in that course? Okay, so I think we've hammered cost enough. Let's have a go at fair value now. Okay, so what is fair value? So to start with, fair value isn't in our conceptual framework, but we do mention market value in our conceptual framework. So I'm sure when we rewrite the conceptual framework, when we improve it, when we put measurement in, fair value will go there. We define fair value, though, in IFRS 13, and we say it is the price that would be received to sell an asset in an orderly transaction, not a forced sale, between market participants at the measurement date. So we kind of know where we're aiming. Okay, so unlike cost, where we don't know where we're aiming because we have a convention rather than a concept, we do have a concept for fair value. Okay, so we know where we're aiming, but getting there is sometimes the problem, isn't it? Okay, a level 3 measurement of fair value, you might know where you're aiming, okay, but how wide is the target? So that's the difficulty. Okay, but just some other things we should consider. Okay, it's a market-based measure. It's not an entity-specific measure, so it's never how much could this entity sell the asset for. It's what would a market participant pay for that asset. So the entity's intention is irrelevant. What the entity intends to do with the asset, use it, keep it, sell it, doesn't matter. And there's a highest and best use principle for non-financial assets. Okay, so you value them at their highest and best use. And this has come up in an interesting case, which we're going to look at in a moment. Okay, so here's a really difficult example for fair value measurement that has really vexed people's minds. And this is the one where the UK regulator, not this exact example, but an example a bit like it, made the company restate their financials twice. That was about palm oil plantations in Malaysia owned by a UK PLC. And the tricky thing is, when the palm trees were planted, the city was far away from the land. So the highest and best use for the land was agriculture. But these trees are long-lived. So in Asia is rapidly developing at the moment, so some of these cities are expanding rapidly, and it grew out to where the farmland is. So now the highest and best use of the farmland is no longer farmland. Okay, the highest and best use is to build a high-rise building, because right next to the farmland there's a high-rise building. And the return you get on a high-rise building is a lot better than the return that you get on palm oil, even though that return's not bad. But the company looking at this, the management, when they're reporting their results, are saying, but our business model is farming palm oil. Based on our cost structure, very old historical costs, or in some cases not necessarily very old historical costs because it's changed very quickly, okay? The highest and best use of the land has changed very quickly. Okay, so this is interesting. And this is going to be largely kind of level 3 measurements as well. Okay, so looking at this example, we're going to do it in 3 scenarios. Okay, I've made this apple farming in Berlin because there's a Polish-German person who works in my team, and I said I'm going to be doing this in Europe, so please tell me a city in Europe that has expanded rapidly where a similar thing might have occurred. And she said, well, East Germany became part of West Germany, or combined into one country, and Berlin expanded rapidly. So what do they farm there? Apples. I said, okay, we'll do apple farming. So we're now apple farming in Berlin, and Berlin has grown right out to our apple farm. Okay. So now, the value of the farmland with the apple trees on it is the same as the value of the farmland without the apple trees on it. Okay, so if we owned the land, its fair value would be the same whether or not it had apple trees on it. Okay, because the apple trees would go and the person would build a building on it. Okay. If we're renting the land, and we have a fixed rental agreement that was maybe you can get long rental agreements, I don't know, maybe 30 years or something, your rentals could be very low. So our first scenario, we're going to say, if we are renting the land and we're not paying current rentals, we've got some historical rental which is insignificant. A level 3 measurement of the fair value of the trees, discounting the cash flows that we expect to get from harvesting fruit from the trees in the use they are currently in, would be 30. But if we paid a market rental for the land on which those trees are growing, it would be 0. These are difficult questions. Okay, so unlike the cost questions, which were easy questions to answer, but we couldn't get them right, here I'm trying to give you the most difficult question that has come up in fair value measurement. And it's my first experiment with this. I want to see if you can get it right. Okay, because there are right and wrong answers to this, I think, anyway. Okay. So we're trying to work out what is the fair value of the trees. measured by a market participant, not measured by us for the purpose that we're putting it to, but measured by a market participant. Okay, and this is the question the UK regulator was answering, or regulating, if you like. Okay, so if we vote on the first one, so if you are looking at scenario 1, so you're using rented land, what is the fair value of the trees that are growing on that land? Is it 30, the discounted cash flows using historical rentals? Or is it 0, discounted cash flows using current rentals? Or is it 23, which is just some apportionment if you had owned the land? So the cost of the land, if the fair value of the land if you'd owned it is 100, the discounted cash flows from growing fruit on that land, excluding the cost of the land, would be 30. So if you add the 100 and the 30 together, you would have 130. So to get 23, we're saying, well, let's just apportion it on the fair value of the land without trees on it and the fair value of the cash flows we expect from the trees. Interesting, though, that you think the fair value can be greater, that the fair value of the parts can be greater than the fair value of the whole. Because the fair value of the land without trees on it would also be 100. This is a difficult question. I certainly scratched my head for a while, so I'm asking you to do it in a second. So I'm asking a lot of you. But it is a difficult question. But it's one that the regulators have regulated. Okay. So what do you think? Shall we key in? You're renting the land, you're paying historical rentals. Based on those historical rentals, if you discount the cash flows from the fruit, you would get 30. If you put in a market rental instead of the historic rental that you've got, your present value would be 0. If you did some apportionment on an imaginary basis that you owned the land, you could somehow come to, mathematically anyway, an answer of 23. What do you think? Okay, all vote now. Okay, have you all voted? Let's have a look at the answers. Okay, about the same as cost, wasn't it? Okay, it's a really difficult question. This is a really difficult question. Okay, so let's try it again in another scenario, and let's see if the answers change. Okay, so now I'm going to ask you to consider you do own the land. Okay, you do own the land. The fair value of the land is 100 with the trees on it. The fair value is 100 without the trees on it. Okay, because a person who bought your land, a market participant who bought your land on that day would cut down the trees and build a high-rise building. So they would not seek any cash flow from the fruit trees. However, if you did farm the fruit trees on it, the present value, excluding any cost for land, okay, would be 30 of the present value of the cash flows from the fruit farming on it, excluding any cost for the land. Okay, and I'm going to make you think about something carefully first. I'm going to ask you to discuss it with the person next to you before you vote. Okay, this question came to our interpretations committee, so it's a difficult question. Okay. But IAS 16 for the land says you can use the revaluation model or you can use the cost model for the land. So I'm going to say to you first, what if you use the revaluation model? Okay, so if you revalue the land, what is the fair value of the trees? It's a difficult question. The staff at the IASB, when they first wrote the paper to go to the interpretations committee about this, okay, wrote some stuff that I think is nonsensical. Okay, that's how difficult this question is. Okay, So you use the revaluation model for the land. So land is going to be revalued to a number. Okay. One way that IAS 41 says you can calculate the fair value of things that are growing on land is to take the fair value of the combined thing minus from it, so the fair value of the land with the trees growing on it, minus from it the fair value of the land without the trees on it, vacant land, and then you're left with the fair value of the trees. And that works, I think, if the land is at its highest and best use, doesn't it? It would make sense, wouldn't it? Okay. But this land isn't at its highest and best use. Okay, so discuss with the person next to you. Okay, so how much do you think the fair value is of the trees that are growing on the land? And remember, these aren't trees you can cut down and sell. These are trees you have to keep growing on the land to harvest fruit from them over many years to come. It's a difficult question, but discuss it with the person next to you and see what they think. And then together we're going to vote. Okay, so shall we take a vote on this now? You've all had a chance to confuse one another. Shall we all vote? If we'd set the voting time, if you'd all vote, decide what you think the answer is. You don't have to agree with the person you discussed it with, but vote and see what you think the answer is. Okay, is everybody keyed in what they think the answer is? Again, don't feel bad if you get it wrong. It's a really difficult question. People have thought about this for weeks before they can think they can come to the right answer. So, okay, I think everyone's had a chance. Let's have a look at what the results are then. Okay, I'm just trying to remember what D was now. So D is 0 is the highest. A number of people on 30. Okay. So now we're going to do it once more. We're going to vote once more and discuss it with the people around you again. You're not using the revaluation method for the land now. You're using the cost model for the land. You're using the cost model for the land. Does that change your answer? Okay, shall we take a vote on that? So key in what you think the answer is if we are using the cost model for the land. Okay, and then we'll discuss the answers once we've had all the votes on this. Okay, so if you're all just keying in your answer, we'll give you a second or two more for you to key in your answer to this one. Okay, I think we can check now what the voting is. Okay, so again, when we're looking at D, and just correct me if I'm wrong, the answer for D was 0. Okay, and it's about the same level. So one thing that pleases me is the same number of people seem to be coming to the same answers. So it seems to me people, and this is what the staff wrote in the paper I saw, that you could get a different answer if you're using the cost model for the land or the revaluation model for the land. And I said, whoa, I think the fair value of the trees has to be the fair value of the trees. So I went to see them and discussed it with them. I said, you know, the fair value of the trees can't change because you're using a different model for the land. The fair value of the trees is the fair value of the trees. Okay. So this would be easy if we accounted for the land and the trees at the same model, wouldn't it? If both were at fair value, we wouldn't be arguing, would we? We would just be saying the total collective thing is 100, and there'd be no arguments. Would anybody want more than 100? Sorry, that is a question worth asking. Okay, yeah, well, I think there are some people who think the collective can be more than 100. Okay, so for those of you that come out to, when you're using the revaluation model, you said the fair value of the trees was, say, 0, for those of you that did. I'm assuming you said the revaluation of the land would be to 100, because that is the fair value of the land. And you were saying, well, the sum of the parts can't be greater than the whole can't be greater than the sum of the parts. So that's how you got to 0. Your total asset that you have is 100. So you can't go above 100. Okay? And that stacks up in my mind anyway. Okay? And that's what the staff said in their paper when they wrote it for the interpretations committee. If you're using the revaluation model, okay, the fair value of the trees would be 0 in this example, because the sum of the parts, okay, can't be greater than the whole. Okay. A few people I've discussed with this with, okay, for some reason, and I don't understand their reason, so it's hard for me to explain this to you, would apportion somehow between the land and the trees. So they would take some historical rate, perhaps, or some current rate to do the apportionment. I can tell you one of the reasons that the UK regulator made the palm tree plantation grower restate was they were using historical proportions. That was their first mistake. And the regulator said, no, you can't use historical proportions. So they were taking the total, it appeared to me, the 100 if you like, and apportioning, I can't say that word now, apportioning it between the land and the trees based on the proportion when the land was being put to its highest and best use when they first bought it. And the regulator said no to that. When they restated, they were using some historical costs rather than current costs in doing their valuations. And the regulator said, you must use current costs, not historical costs. So twice they had to restate. Okay, so the regulator was saying, in my mind anyway, okay, that you have to be using the current values, okay, in order to make the determination of what the fair value was. Okay, so what I'm trying to do with this one is take probably the most difficult fair value question that has been asked in the time that I've seen fair value questions come up. Okay, and show, well, there is a target that we're aiming at, and if we know what the target is that we're aiming at, okay, we should be able to get to a consensus around what a faithful representation of what a relevant information would be about that thing. Okay, but it is a very, very, very difficult example. Okay, so we're going to do some more examples. So we're going to ask which model better enables us as primary users, as investors, lenders, and other creditors to project future cash flows. That's what we're trying to do. This is another real-world example, by the way. This is, I had a friend of mine who works for a car manufacturer, and he says, our car manufacturing company went to this great developing country before other car manufacturers did. Okay? And therefore we can sell cars at a lower price than our competitors can manufacture cars at. That's interesting. I say, you don't think that the fair value change in your factory, because the fact pattern that we're looking at here, the factory cost us 1 million to build. Oil was found in this developing country, and prices quadrupled. So I build my car factory today, it costs me 1 million. You build your car factory in 3 days' time, it costs you 4 million. We manufacture essentially the same car. Mine has a different brand on it, but it's essentially the same thing. Okay, cars are fairly comparable things. It's essentially the same car. The cost, if I'm using the historical cost model for depreciation in IAS 16, the cost of each car that I build is 100, because I'm allocating a very low factory cost. If I use the revaluation model, though, so I revalue my property, plant, and equipment, my depreciation cost would obviously go up, and the cost of my car would be 300. 300 is the same as the cost of your car. I'm selling cars at 250, okay, which is less than the cost of the car if I use the revaluation model, but more than the cost of the car if I use the cost model. You can see the problem with the cost model. Already I've got two costs for one thing. Economically, what is the cost of this car? Is the economics that I made a fair value gain on my factory, the fair value of my factory changed from 1 million to 4 million, and what I'm doing now is I'm offsetting that 3 million gain against depreciation expense. Is that economically what's happening? Or is economically just that the cost of every car I manufacture is 100? And it matters. These are long-lived plants. This plant is used for 50 years. These are difficult questions. So I have a particular view. Your view might be different from mine. But economically, what is the cost of the car? And the great thing about economics, there can be only one answer. So economically, it can't be A and B. Economically, it has to be A or B. Accounting, we can have A, B, C, D. We can make up as many answers as we like. But in economic terms, there is only one answer. And I'm making you think about things you probably don't think about every day. But this matters. Accounting is supposed to reflect economics. Otherwise, how can it be used to make investment and lending decisions? So if you are buying a factory or a company that manufactures cars, what information is helpful to you? Is it helpful for you to think that they have a huge gross margin on manufacturing these cars? And would you then, when you project going forward, when they build their next factory, they will have the same margin on the cars that they build? So economically, are they selling cars at a profit of 150? Or economically, are they selling cars at a loss of 50? Not what does the accounting say. We make that up after. So if your answer is going to be a loss of 50, you're going to say the economics is I made a gain in the fair value of my plant, I could have sold the plant the very next, 3 days later for 4 million. So I made a gain of 4 million in my plant, and I'm using up a plant that is economically 4 million to manufacture cars. Therefore, the cost of the car is 300. I'm selling it at 250. I'm actually making an economic loss of 50. It's not necessarily irrational to do that, to get market share. I'm sure companies do that all the time. It's not necessarily irrational to do that. Or am I really making, economically, a profit of 150? Because, in fact, I only paid 1 million for the factory. So my gain is not a gain in the increase in the fair value of the factory. That's not economics. I'm just giving it the other view, if you like. The other view would be that's not economics. The fair value of the factory is irrelevant. It's not an economic factor. I'm using up a historical cost that I had incurred, okay, in order to manufacture these cars. So I'm consuming in each car part of the potential of my factory to manufacture cars. And that part is only 100 for each car I'm manufacturing. And there can be only one economics. There can't be two. Okay, so I'm going to ask you to discuss this with the person next to you. Okay, and what do you think economically is going on here? Not what is the accounting. We all know what the accounting is. You've got a choice. You can do one or the other. What economically is happening here? This is what the board does. When they're setting standards, they have to try and work out what would provide useful information to investors, lenders, and other creditors to help them project future cash flows. It's interesting. And this is why accounting is not boring, because this is what you're thinking about when you're doing accounting. Okay, shall we vote? Okay, if everybody would key in what they think economically the case is. Is it A, a profit of 150, B, a loss of 50, or it depends? It depends on my business model somehow. I've got a cost model or a revaluation model. Okay, and remember, that's not accounting. This is now some kind of economic cost model or revaluation model, because accounting we haven't got to yet. You can only do accounting once you understand economics. If you're trying to do accounting before you understand economics, you're barking up the wrong tree, I think. Okay, shall we look at what everybody keyed in? Okay, it's interesting. So the majority of people think that what we have is a 150 profit. A number of people, 20%, think we have a loss of 50. Okay, and others, it depends. They think there's a kind of business model going on here. Okay, so they think the economics can be different depending on a business model. Okay, so that's interesting. Okay, now I can't tell you what the right and wrong answer to these things is. I have a personal belief as to what the answer is. Now I can share that with you. I'm not in the majority. Okay, because I think if I'm a user using those financial statements without other information, I'm thinking this company is making a huge profit on manufacturing cars, a huge margin on manufacturing cars. When economically, I don't think they are. Economically, they had a gain on the fair value of the factory, which was a gain they could have realized that day. They could have sold the factory to somebody else and realized that gain. So economically, in my mind, okay, there's a gain on the fair value of a factory, which they're offsetting against the cost of the cars that they're manufacturing. But that's my view. And the nice thing about accounting is we can all disagree. Okay. Okay, so of course, you know, when it comes to the accounting said you could do either. IAS 16 says you can have a revaluation model or you can have the cost model. So IAS 16 allows you to capture both of the economics that we've envisaged in this room. Okay, but I challenge you to think that there cannot be two economics, there can only be one. Okay. Okay, so now let's look at another example. Okay, and this is another real-world example which happens every day. Okay, here we purchase or we build a purpose-built multi-story car park, or a parkade as it's called in some places. And to pay for the person who we are acquiring this multi-story car park from, we pay them $900 today, the day we get control of the car park. And we promise to pay them a further $200 if more than 1 million cars park in the parkade within the first year. So it's a contingent purchase price. And again, to get to the answer, we have to say, well, in accounting, first, I can tell you that we use different answers. If it's business combinations that we were doing this in, okay, we would say, on the day the business combination happens, we would calculate an expected value using probability, and we would say, you know, the fair value of the parkade on the day we bought it is 1,000. There's a 50-50 chance that the million cars will go through, so one answer could be 1 million. The 900 we pay, plus 50% chance that we will pay 200, giving us another 100. And some people look at that and say, but hang on, that's never the number that you will actually pay. The number you will actually pay is either 900 or it's 1.1 million. It's either 900,000 or 1.1 million. So either you will or you won't pay the contingent purchase price. So if you're doing business combinations in the IFRS for SMEs, for example, okay, you would say it's less likely than not at the time you bought this parkade, so you would use the 900 as cost, okay, and then you would adjust it to 1,100 when the millionth car drove into the, or it became probable that the millionth car would drive in, and probable meant more likely than not in that case. Okay, and in the other standards where we're just buying an asset rather than a business combination, it's not clear which answer we should have. Okay, so economically is what you're asking yourself again now. Does the change in the probability from 50-50 to 60-40 or 40-60 or eventually 0 and 100 eventually, okay, one way or the other, does that reflect what we pay for the parkade, the cost of the parkade, or does that reflect the performance of the parkade? So if it affects the performance of the parkade, you would be saying, well, my expected value, the current business combination calculation, takes account of the probabilities that we would get to pay the 200,000. So my current expectation, if you like, is captured in 1 million. So if that's your economic view, then you would be saying any number that we come to other than, so as that expectation changes, that's to do with the performance of the parkade, not the cost of the parkade. So we wouldn't change the 1,000. But others might say the economics is we pay 900,000 for the parkade, and we adjust the cost of the parkade for this contingent purchase price. So it's got nothing to do with the performance of the parkade, it's to do with the cost of the parkade. So in business combination accounting, the reason why the board came to the conclusion that they came to is they were saying, well, you're paying for something, and in working out how much you're prepared to pay in a business combination, okay, you're going to weight all sorts of probabilities. Okay, and they use expected value, if you like, to weight all those probabilities, and any adjusting figure is going to be goodwill. And their conclusion in that standard was any change in those probabilities would be to do with the performance of the assets and liabilities rather than a change in the fair value of the thing at that date. Okay, but here, we could be speaking about cost rather than fair value. Okay, so what do you think the economics is? Okay, and is the economic of cost different from fair value? Okay, so a way to put that economically is, does the change in the probability reflect in the cost of the parkade or the performance of the parkade? Okay, so is the cost of the parkade 900, 1,000, or 1,100? And remember, there is a line that says the contingency is met and paid in the fourth quarter of year one. So we did eventually pay 200,000. We did pay the 200,000. Okay, do you want to key in your answers and see what you get? Okay, has everybody keyed in their answer? Okay, let's see what everybody votes. Okay, so again, it's difficult, isn't it? Okay, some of you agree with the board, what they see the economics to be with. Some of you see something different. Okay, maybe some of you keyed before I'd pointed out to you that there was the line that said the actual eventual payment that you made was the 200,000 plus the 900,000. Okay. So I think, if nothing else, you get a greater appreciation of how difficult it is to set these standards. The people in this room on this one question, which is something that comes to our interpretation committee fairly regularly, is almost exactly split across the three possibilities. Okay, so we'd have to decide what is it that we are measuring. If we're measuring fair value, then I think the answer is clear. Okay, because fair value would involve, at the point of control, working out what a market participant would pay with all those characteristics at that point in time. So if you were doing a fair value measurement, I think the answer clearly would be 1 million. But if you're doing a cost measurement, well, it depends what your convention is, I think. Okay, so we can write the convention to be any one of those three numbers. Okay. So you can see some of the difficulties for the IASB, okay, in trying to set these requirements. Look how you split 3 ways on that particular issue. Okay, and before we get to the case study, the last thing we're going to do, our case study today is actually example 1, so I'm not going to do example 1 on this slide with you now. Okay? But there's some things in accounting that we find very, very perplexing. The board really battles to set the accounting for some of these things. Okay? Particularly the measurement. That's what matters. That's what's difficult. And there are 3 things there. There's own credit risk downgrades for banks in particular. And people look at the adjustment going, which we now say goes through OCI. Okay, so income, when your credit rating is downgraded, and people say, many people say that's counterintuitive. Others say it reflects economic reality. Okay, so that's the question we're going to be asking you. Is this economic reality, or is this nonsensical? Okay. And then we can do the same for cap and trade emission trading schemes, which we have, for example, here in the European Union. I remember when the board was discussing this together with the FASB, the US standard setter, how to account for these things. We were sort of doing a research project. We were early in the phase. And I remember somebody saying, one of the board members saying to the staff, go find the liability. And one other board member said, no, that's like looking for a needle in the haystack. And a third board member said, there is no needle in that haystack. Okay, so that's exciting, setting standards. But does seeing the big picture help you see whether this is income when you get this certificate or whether it is a liability? Okay, and I read an article just the other day that was written by a former board member from Australia, Warren McGregor, which for the first time made me think, why didn't I see that before? So we're all learning all the time. Okay, so, and the third one we're going to look at is one that comes from Warren Buffett, you know, the wealthy investor. I think he's the richest man in the world, Warren Buffett. And if you've read his letters to his shareholders, or his investors, if you like, for the last 2 years, he's been very, very critical of a particular piece of US GAAP. And I'd love to say, well, that's US GAAP, it's different from IFRS, but IFRS happens to be exactly the same. So we can't go down that route, we have to answer the question. Okay, and this is a really interesting question which we're going to vote on as well, so I'm just giving you a bigger picture before we do the voting on this. But he says, and I forget the numbers, so I'll just use my numbers. Okay, he says, I buy 75% of a company, okay, and I pay a whole lot of money for it, and I do all the fair value calculations, and I'm happy with the accounting for the business combination on the day I get control of the subsidiary. But then I keep the subsidiary, so I don't sell the shares for maybe 10 years, and then I buy out the non-controlling interest, the people who own the other 25%. And let's say he says, I pay 10 billion, so credit bank 10 billion, the money's gone, that's easy, we all agree, credit bank 10 million. Debit non-controlling interest, if you're looking at consolidated accounts, debit non-controlling interest, and the non-controlling interest is only, say, 4 billion. It's always billions when it's Warren Buffett. So, you know, accounting, we have debits and credits, and they all have to balance, so the 6 billion has to go somewhere. So no one likes where the 6 billion goes. So the FASB and the IASB, when they set the IFRS 3 together, said the US were a bit more specific than the international people. So we said, we're not going to tell you where in equity it has to go, because we appreciate many different countries have different laws which determine different classifications for their equity. So we would be looking for a hiding if we try to tell you where in equity it had to go, because that's a lot to do with the law in your country rather than the standards that we set. So the Americans were specific, and I forget what they called the account, but he knocks it fairly hard. Okay. So he's basically saying, I'm spending good money, 10 billion, on I think what he calls the surest of sure bolt-on acquisitions, and my equity is going down by 6 billion. And European analysts looked at an IFRS company when IFRS 3 was first applied, who's now an academic, Dennis Jullens. And he was looking at it was a Swiss company. One Swiss company bought another company, and you know the same accounting comes out, so we have the same accounting. And he was saying this is just accounting. So your return on equity goes up. So you look like a much more profitable company. Your return on equity is going up a whole lot. Okay, is how the UBS analyst was looking at it. You're saying that's just accounting. Don't be fooled by the accounting. The economics is different. Okay. So what are the solutions? Why does this problem come about? Let's do example 3 first. Why does this problem come about? Okay, at the point of time when the business combination happened, all assets and liabilities were measured at fair value. So the minority interest or the non-controlling interest was at fair value. I know we've got a choice in IFRS, there's slight options, but let's say we're using what I'll call the full goodwill method. Okay. So minority interest is at fair value. So at that time, if the next day he had bought the other 25%, and let's say at that time he would have paid 2 billion, so it would have been credit bank 2 billion, debit non-controlling interest 2 billion, no problem, everyone would be happy. But how do we measure non-controlling interest? Well, we start at fair value, don't we? And then we adjust it for changes in the group carrying amounts or book values measured under IFRS of all the subsidiaries' assets and liabilities that are recognized. because there are a whole lot of unrecognized ones that we don't even put in the books. Okay, so what happens over time? Non-controlling interest drifts away from its economic value, as all things that are measured in a mixed measurement model would drift away from their economic value. Okay, so maybe they develop some new brands. We don't put brands in the books. Okay, so those new brands wouldn't be in there. Take a guy like Warren Buffett and his team coming to work on this company. It's likely that the value of the brands increase significantly over 10 years whilst he's involved with the company. So the fair value of the non-controlling interest is no longer what you see in the books. You now see just a mixed measurement number that's based on a starting point of fair value, but adjusted for all other measures that we have in IFRS. And remember how many different measures we do have. So one way we could fix the problem is to say, credit bank, 10 billion, debit non-controlling interest, 10 billion, and I think he'd be happy with that. But how would we get there? Well, there are two things we could do. We could either measure all assets and liabilities at fair value all the time, and non-controlling interest would therefore be at fair value, and I can see enthusiasm fading. Or at the point of that transaction, we could remeasure at fair value. And some people say, yeah, I like that, because now we've got a market transaction, so we can, we've got something reliable is the word people use, okay, misuse, okay, to get to that number, okay. But then at that point in time, so it would work. He would have a gain of 6 billion, okay, because we'd have to restate all the assets and liabilities to fair value when that transaction happens. Okay, so there would be a 6 billion gain in the group accounts. Okay, and then he would credit bank 10 billion, debit non-controlling interest 10 billion. Okay, make sense? Or we could just debit something else. So we could credit bank 10 billion, debit non-controlling interest 6 billion, or 4 billion, I think I said, sorry, 4 billion. And then you'd have to debit some asset. Call it like goodwill or something. Okay. But what's the problem with that? Well, we already have the subsidiaries' net assets in the books measured at some other value. So what's this other little value that we have here now? So now, how am I supposed to try and project future cash flows when I've got some of the value in there mixed with a whole lot of other things, and a bit more of the value mixed in here with a whole lot of other things, assets and liabilities offset against each other? How am I going to use that to project future cash flows? So the solutions to these problems are not easy. What's the problem with revaluing, if you like, remeasuring, only when we have the business combination? Well, as regulators, I think you'd be concerned. Because management, whenever they want to record profit at a number different from the number they've got today, all they would have to do is, buy a share from a non-controlling interest, and you can remeasure all your assets and liabilities in the subsidiary. Get some profit. Yeah, so that's not a great solution to the problem. So what's the solution to the problem? Okay, not easy, is it? Okay. So shall we vote on these? So let's just go, which is the first one we've got here? Okay, so we're going to do a whole case study on this one. So you're going to vote on this issue again after we've considered it a whole lot more in the next hour. But just for now, let's take a quick vote on own credit risk. So your own credit risk gets downgraded. Okay, so your liabilities that are at fair value go down. Okay, so you're debiting a liability, you've got to credit something because we've got, this double entry bookkeeping thing. Okay, and we credit income. Okay, and in IFRS 9, we now put that in OCI, for example. Okay, but it's still income. It doesn't change the fact that it's income. Okay, and some people say this reflects economic reality, and others say this is nonsensical. Now's your chance to say. Which do you think? Is that reflecting economic reality, or is that nonsensical? Okay, A or B? Okay, everybody voted? Okay, let's see the answers. Okay, so a little bit more think it's reality than think it's nonsense. Okay, so we're going to come back and look at that later today as well, once we've done the case study, to see if we change. And it is always good to change, by the way. I think if you're not learning something new, including me every day, okay, we've wasted a day. So, we had to do it. Okay, so that's interesting. Now let's look at the next one. Let's look at cap and trade emission trading schemes. So a little bit more background information on this one. What some people say, and I'll just give you the two views without saying what I think, but what some people say, okay, the government gives you these certificates today, and let's say it's the last day of your financial year. They're licenses to pollute, if you like, for the next 3 years. But you have to give back the certificates to the extent that you've polluted, but they are tradable certificates. You can sell those certificates to anybody you want. You can buy certificates in the market, as many as you want, okay, when you have to hand them back. Okay. So the question was phrased as it equals income. So some people would say, you've clearly got an asset. I think everybody says you've got an asset when you get these certificates. So the question is, what do you credit? Do you credit income or do you credit liability? So think if you credit income, you're going to have a lot of income, and then as you pollute over the next few years, you're going to have expense. Whereas if you credit liability, and this is what people say, if you credit liability, okay, then that liability will come in expense as you pollute. Okay, so you don't have that volatility. And then what I read somebody else write the other day was, hold on, we'll use Australia and New Zealand because that's the example he used. Okay, so if New Zealand implements an emission trading scheme, but Australia does not, and it's a common market, okay, like the EU's a common market, okay, then if your factory was in New Zealand, your factory would be impaired. Okay, assuming that your factory was on the revalued basis, you would see an impairment of your factory because you now have costs that your competitors don't. Your competitors don't have this cost of an emission trading scheme where you do. And you can see in the world, so the Kyoto Protocol was signed, and then everybody steadily backed out, except mainly the EU. I think, we can all be proud that we've kind of stuck with it a bit more than everybody else has. Okay. But we do impose a cost on our businesses that other people don't have. So when you see it in that light, you can say, or some people would say, these certificates you get, this asset, this is compensation for the impairment of your factory. So impairment expense on your factory and income, emission trading scheme certificates that you've got. So there are different views on this. Okay, so what do you think? Is crediting income reflecting economic reality, or is it nonsense to do that? Is it nonsensical? Okay, we give you a lot of information to process quickly, I know. But this is what the boards are doing all the time. They're trying to write standards to address these issues, and they are difficult. Okay, so everybody vote, A or B. It reflects economic reality that it's income, or it's nonsensical, it should be liability or something else. Okay, everybody vote now. Okay, I think we can look at the results. Okay, and again we split. Okay, so it's difficult, isn't it? Now you haven't had long to consider it, but these are things the board is thinking about all the time when they're setting requirements. Okay, now let's go to Warren Buffett's question. Okay, so Warren Buffett's question is, when we buy out the non-controlling interest, okay, we pay 10 billion, credit bank 10 billion, debit non-controlling interest 4 billion, because that's what it happens to be at in our books, and it's no longer there. And the 6 billion goes to equity, a decrease to equity. Is that nonsensical, as he says, or is that reflecting economic reality? So A is reflects economic reality, or B, nonsensical? Okay, everybody vote now. Okay, shall we see what everybody voted? Okay, again. So you appreciate how difficult the job is again. Okay. Now, Warren Buffett's not a man I want to disagree with. He is the richest man in the world. Okay. So again, it's interesting, isn't it? Okay, but if you do see it as nonsensical, remember we discussed fixing that problem and how difficult fixing that nonsense would be if you do see it as nonsense. Okay. So when we wrote the standard, we said, so our standard says this is what you do. You debit equity. Okay, because it's a transaction between shareholders. If you look at our conceptual framework, okay, we say, yes, it's not a liability. Minority interest is an equity. Therefore, it is a transaction between equity holders. So in terms of are we classifying these accounts correctly, is the net result that it's going to equity correct in terms of our conceptual framework? Yeah, the mechanics of that works in terms of our conceptual framework. But, you know, the richest man in the world who made his money out of investing is saying this is not making economic sense. Okay, because he's going to his shareholders and saying, you know, we're making a sure as, you know, certain bolt-on investment that we can make, and yet our equity's going down. It looks like we're throwing money away, our asset base is shrinking, when actually, you know, we're making good investments with that money. So it's an interesting question. Okay, so with this as background, just to so you appreciate better now how difficult it is for the IASB to work on measurement. We're working on it on the conceptual framework. We need your help. Okay, please don't be as split as you are now when you give the help, otherwise it just continues to be very difficult for us.